Hey, what's going on, guys? And welcome back to my channel. Today, I'm going to be talking about some of the more high yielding Dividend Aristocrat stocks. Generally, when we're talking about stocks that are high yielding, it usually means that they've been beaten down a lot. And the same is true for the three stocks that I'll be talking about today. Some of these stocks have been beaten down for 1 year, 2 years, or even up to 3 years. So we're going to take a look at these both from a technical perspective, but also from a core business perspective to see if they're actually bargains or whether they're bargains for a reason, and maybe we should stay away from these stocks. Before I get started with the analysis, I want to give lots of credit to this website called suredividend.com. So suredividend.com does a lot of analysis on each of the dividend aristocrats. I'll be sure to include the link of this website in the description down below so you guys can do your own research after this video as well. So starting off the list is Abbvie, ticker symbol ABBV. So maybe to no one's surprise, this is actually the highest yielding dividend aristocrat stock, currently at around 6.4%, and their share price is around $64. Abbvie, along with a lot of other healthcare stocks, have also been beaten down, but certainly not to the extent that Abbvie has, and especially not for an aristocrat. So first, let's go ahead and take a look at Abbvie from a technical perspective. We can see that Abbvie continues to make new 52-week lows, and they peaked somewhere around the start of 2018 here at around $125 per share. And ever since then, at least for the past couple of years, they've actually decreased by about 48%. And like I said, they're currently at around $64. A lot of people thought that this drop here on the week of June 24th, where they bottomed at around $65, would be the bottom. But as I make this video, they're actually making new lows. And so their 52-week low currently sits at around $63 per share. So the real question is whether they'll bottom soon. And so one thing I'll point out is that RSI is oversold. RSI on the weekly time frame is currently at around $28 per share. But the main takeaway is that they're actually below both major moving averages, which kind of means that they're not really in an uptrend, and that's to no one's surprise. But generally, with a lot of trend following systems, we want to make sure that even if stocks are beaten down, that they're still at least in somewhat of a trend. And Abbvie seems to be breaking those rules just a little bit. But the other main question actually is, if we start to continue lower, will Abbvie still be able to pay out that juicy 6.5% dividend yield? Because similar to stocks like Kraft Heinz, when their share price got too low, it just became unsustainable to keep up that dividend payout, and so Kraft Heinz had to cut their dividend yield. The question is Abbvie going to be in the same position or not? So one of the main headlines with Abbvie is that they're losing patent protection on their superstar drug, which is Humira. This is actually a really big blow because Humira represents about 50% of revenue and up to 70% of profit. However, it's not as if the CEO of Abbvie woke up one morning and someone told him that they were going to lose patent protection on their star drug. They've certainly had a lot of time to plan around this, and so in the pipeline, they're actually well positioned in immunology, and immunology is drugs basically relating to the immune system. Beyond immunology, they actually have a pretty strong lead in blood cancer drugs. Their star drug, which is Imbruvica in blood cancer, is actually projected to be one of the more successful drugs in blood cancer. And as far as the remaining drugs, which is basically not including immunology and not including blood cancer, some of those drugs have a pretty high barrier to entry, especially with the complex genealogy. So they seem to be a bit safer on those drugs and have more of a moat. And as far as what they've done recently, they've actually acquired Allergan. And in my opinion, this is nothing more than a way to kind of offset the loss of Humira. Allergan is actually a pretty strong cash flow entity. And so I think they really value the fact that they are an aristocrat and they want to still be able to reward their shareholders. And so that's pretty much the main reason for the purchase of Allergan. So in summary, while I do think that Humira is a big blow to Abbvie in the short term, I think that they're pretty well positioned in other drugs. And I think that they have a pretty nice moat in other drugs as well. Next stock on the list is AT&T, which is a telecom stock. AT&T currently sports pretty close to a 6% dividend yield, and their current share price is around $34 per share. Let's go ahead and take a look at them from a technical perspective as well. So we can see that AT&T has respected a particular trend line ever since around 2002. So that's pretty much a 17-year trend line acting as support. And so we can see that the most recent time that it touched this moving average or this trend line, AT&T bounced from around $26 per share all the way up to around $35 per share. So that's an increase of about 30% the last time it touched this trend line. So in the short term, I wouldn't be surprised if we see some upcoming volatility with AT&T, especially because some of these moving averages are starting to trend in that direction. And generally with AT&T and lots of really high dividend stocks, we don't really have a clear uptrend. And so AT&T is generally no exception. As you can see, these moving averages are kind of going sideways and not really acting as support, but at the same time not really acting as resistance. So the trend is not strong, but in my opinion, the really nice dividend yield makes it a good investment. Full disclaimer, I'm actually long AT&T, but let's go ahead and take a look at it from a business perspective. So AT&T has made it very clear that they plan on becoming more diversified, and instead of just being a telecom company, they also want to be a media company. So they recently purchased Time Warner Cable. That acquisition did leave a lot of critics scratching their head, especially because AT&T took out a lot of debt in order to make that acquisition. And the question that remains to be seen is whether that's going to be a good return on investment. However, what AT&T had in mind was basically bundle packages. And so bundle packages are basically like when you buy a bit of telecom services, you can also get some cable for some kind of discount. And so in my opinion, I think these kind of acquisitions make AT&T a bit more forward thinking than other telecom companies. I mean, for the most part, they're definitely way ahead of T-Mobile and Sprint, and they practically have a duopoly on telecom in the United States with Verizon, of course. Some of you may have heard of Verizon. Of course, that was a joke. But yeah, like I said, I think that they're forward thinking, and the acquisition of Time Warner is more than just a cable acquisition. I think that they're thinking more long term than that. That's basically because Time Warner Cable is also Warner Media, which has a pretty large collection of media in the form of TV shows and movies. And so that's going to open up the way for basically, attracting a lot of content creators. And they basically own a lot of content creators, which paves the way for collaborations with other media companies like Netflix and Hulu and Disney Plus. And so I think they saw a position of owning media and they're going for it. And I definitely respect that a lot about them. And whenever you have technology companies that kind of make a leap in kind of the nearest sub industry or subsector, like you have with Apple, for example, Apple is not just a consumer electronics company anymore. They are also becoming a bit of a services company. And I definitely respect that. And so, yeah, I'm long AT&T, and I'm a happy shareholder of AT&T as well. The last stock I'll be talking about is Exxon Mobil, which actually might be the most controversial stock on this video. So Exxon Mobil plays close to around a 4.7% dividend yield, and they're currently at $70 per share. Let's go ahead and take a look at them from a technical analysis perspective. So as you guys can see, they've been in this trading range ever since the 2008 recession for the most part. They're currently at around $70 per share, which is actually the same level that they were here on August 7th, 2006. So that's essentially about 12 or 13 years of going nowhere. 12 or 13 years of being stuck here at around $70 per share. Like I said, they have been in this range since around 2010, but it looks like they're going towards the bottom of this range. And I wouldn't be surprised if this trend line starts to act as resistance if we try to get back above it. ExxonMobil is also pretty highly correlated with the price of crude oil. As some of you are aware, crude oil took a hit here in 2014, 2015, as pretty much reflected in the stock price with ExxonMobil. So yeah, it definitely has a lot of critics, a lot of doubters, and I'm actually one of them. So I am not long Exxon Mobil, and I don't plan on being long Exxon Mobil, especially because of the uncertainty of crude oil prices. But still, I think it's worth it to jump into the business fundamentals. So I'm not personally invested in ExxonMobil, but I can certainly see why other people are. So ExxonMobil has made pretty big promises recently. Number one, they plan on focusing less on just shareholder returns, and they plan to focus more on capital spending, which I think is a pretty good move on ExxonMobil's part. One of the big promises that they made recently, however, was that they plan on doubling earnings and cash flow from 2017 levels by 2025. So let me repeat that. They basically plan on doubling earnings and cash flow that they've made in 2017 in an 8-year span. They also plan on increasing return on capital employed to 15% compared to 9% in 2018. So that's pretty much an increase of about 40% on return on capital employed in a 7-year span. So like I said, these are pretty big promises that they feel they can do, and I think for good reason because they are one of the better operators, they are one of the better developers, they're also one of the better processors, especially because they have a stronghold in chemical segments, which I think makes them a differentiator between the other oil and gas companies. It's no doubt in my mind that they're actually, 1A and 1B in terms of oil and gas here in the United States. And while I still think that oil prices will be volatile in, maybe the next 5 to 7 years, pretty much as long as crude oil can hold above $40 per share, I think that the dividend yield is safe. So if you just want to invest in ExxonMobil for the dividend yield, and basically the capital appreciation is just like a cherry on top, then go ahead. I think ExxonMobil is not a bad company, especially because in terms of exploration, they also have a pretty nice stronghold there as well. And that's whether they do their own exploration or whether they actually acquire new mines. For example, they recently strengthened their portfolio through discovery and acquisition. So that's a few places that I'm going to name that I've never actually said out loud before, but they basically have the Guyana project, the Permian project, and also the Mozambique project. And of course, all this is going to increase output, up to 2025. So even though I think they've made big promises, I think that they can deliver, and especially when we show times of dampening oil prices, I think that's opportunity for some of these oil and gas companies to actually lean down and be more efficient, especially because historically oil prices have been around maybe $100 a barrel and that kind of thing. So in anything, I think ExxonMobil has gotten more lean and better in the process. And who knows, they might be a good investment. I just personally don't want to invest in them just for the dividend yield. I might wait for them to look a little bit better, and that's totally fine. So, in summary, I'm long Abbvie, I'm long AT&T, and I am not long ExxonMobil. And basically, the main topic of today's video isn't just are these companies going to go bankrupt in 5 to 10 years, or are these companies going to cut their dividend yields in 5 to 10 years. The main topic is are these companies good places to put our money in over the next 5 to 10 years? Just because I think ExxonMobil is still going to be around in the next 5 to 10 years doesn't mean I want to put my money there more than another company. And so that's pretty much why I'm not long them, but I still think they're a great company. With that out of the way, I hope you guys enjoyed the video. I hope you guys learned something. Let me know if you like this format of technical analysis plus business fundamentals. It's definitely something new for me that I'm trying out. So yeah, hope to see you guys in the next video, and good luck trading.